Hello everyone. Thanks for joining us this almost afternoon. So in the chat, I just wanted to start maybe with just mentioning some housekeeping rules. So um, all participants are muted and cameras are switched off during the session. If you do miss anything or if you want to have a look at the webinar in your own time after today's session, you're welcome to find the recording on YouTube. And then to make the session a bit interactive, please raise your questions in the chat box for us. I really appreciate any interaction, and I think that's our aim for today, is to really have an interactive session with the participants to add as much value as we can. And there is some additional links related to Amazon. Additionally, you'll also find I've uploaded the PDF version of the slides that we'll be addressing, as well as a PDF version of a Google Sheet workbook explaining some of the working capital scenarios and items that we will be discussing. So yeah, without further ado, I would like to just maybe do a quick introduction about myself and the company that I'm from, and also just to introduce the webinar and what the aim is. So um, I am from Arts CFO, as you might see from my virtual background. So Arts CFO is an accounting and financial services company. So we work in the areas of financial accounting, integration, and then our flagship product is the fractional CFO services. So that's also the department that I work in. And as a fractional CFO, to some extent, the name explains what it is, but I'll just give a bit more background as to what we do. So essentially, we sell CFO hours to companies, and specific companies are trying to scale and grow their business. Our model is based on an hourly package, for example. So you'd either do we structured in 8 to 16 to 30 hours just to have a standard sort of package, but we can tailor make that package to also suit your requirements, whether that be something specific like 4 hours only. And the idea behind the model is we've realized that certain companies cannot afford a full-time financial professional, especially in the early days of the company. And so therefore it makes sense to, and from affordability cost perspective, it makes sense to outsource that to get that expertise within your company and to help you basically navigate the challenges and the complexity that revolves finances and understanding your business. And today we are basically going to look at cash flow forecast, cash flow principles, first of all, and then a bit of forecasting and one or two things that I've specifically tried to address in the Amazon space. So with this webinar, I do realize that each of you might be running different types of business on the Amazon platform. And so to add value and get the most from it, it's best to stick with principles rather than trying to look at a specific business setup. But working with the principles, hopefully that can guide you into some of the decision making. So we'll look at the cash flow, and then one decision that I believe majority of the Amazon sellers are facing is whether to how to do the fulfillments. Do you do that by yourself, or do you make use of the fulfillment by Amazon? So we'll delve into that a bit in terms of how do you look at that from a financial perspective. So this will sort of be like a small demonstration of what you can expect from like a fractional CFO or financial consultant helping you in your business. And like I said, please do raise any questions in the chat. So, like I said, we'll be looking at the cash flow principles, and specifically, I don't know if anybody's that's joined the webinar that's read the book Scaling Up. Highly recommended book in terms of cash flow principles and just general ways about scaling up your company. But today we're specifically looking at the cash flow, and then, like I said, I've used the fulfillment decision as a decision making as an example of how we could approach some of these principles and concepts. So within scaling up, you will find there are 7 levers to any company, and for it to be successful, you need to master these 7 levels. So, or 7 levers, sorry. So first of all, price, cost of sales, volume, overheads, accounts receivable, inventory and payables. And then we find there are two main subsections which I'd like to explain today. The first one is being profitability. So that is all doing relating to margins, costs, overheads, all of those items. And then the second one, which is very important, is the working capital. And to my experience and expertise, the one that is most significant to having a company be sustainable and scale successfully in the future with cash flow and making the business work. So, in terms of the scaling up cash flow, I just want to, there's some formulas that we use to understand. So, today I want to really unpack the working capital to just land these principles and why they are important. So, I think maybe not everybody on the webinar is familiar with all of these fancy calculations, but um, I think it's just good to maybe mention some of it, and obviously for you guys to start considering these metrics and how you can incorporate them in your business. So the age-old one and the easiest one that people generally and do understand is the working capital days one, which is basically whether you're looking at inventory, debtors, or creditors, you would calculate that in terms of a day's expression, how long days, for example, do your customers take to pay you, what's your inventory turnover days, and then how long do you take to settle your supplies. Now, all of these gives you some indication as to your working capital cycle, but it's a bit hard to quantify and make sense of the days. And hence, for today, we're going to look at the marginal cash flow principle, and that's the one that they've also adopted in the scaling up book. And it's a very practical way at looking at it and understanding your cash flow cycle to some extent a lot better. So what I'll be doing is to make it a bit more practical is I'll stop sharing there and open up a Google Sheet that I've prepared for this very purpose. And I think I might need to increase the size of it. Yeah. So I've created these three scenarios. Basically, scenario four we'll get to later, but the three scenarios is a step approach to understanding the working capital and the cash flow cycles a bit better. So let's say, for example, and I've kept the scenario the same, but the working capital is where things are changing, so that we can really start understanding cash flow and how that impacts our businesses. So in scenario one, we see that the company is doing revenue of 100, cost of sales of 50, so it's got a 50% gross margin. There's overheads, and then our net profit is 20. So in all scenarios, we keep the net profit the same, 20%, but I want to show you what happens on your balance sheet, and specifically to these working capital levers. So scenario one is typically, I believe, for most of you on selling on Amazon websites, it's you obviously pay with checkout, so you don't really have any debtors, or if there is any debtors, it might be very small amount of debtors. It's not your main working capital items. Of scenario one is just to explain or lay the foundation first. So if we don't have any debtors, we're not carrying any stock. So let's say we've sold all the stock, there's no inventory left, there's no creditors, so we expect our bank balance to increase by 20%. That's exactly what the 20 rand or the 20%, that's exactly what we're seeing. If I scroll down in terms of attaching percentages and the marginal cash flow, like I referred to, that's really what I want to show you. So the 20% is the profit that you take your profit over sales, that's 20%. Marginal cash flow is to look at all the working capital items and then as a fraction of sales as well, because it's all zero, the marginal cash flow from the working capital is zero, and so therefore your net cash flow movement for that period will be 20%. So by simply multiplying your revenue by this percentage, which is the marginal cash flow percentage, you get the movement on your bank. So this was just a quick check. So the opening balance was zero. Our net cash flow, as calculated above, was, this is the normal cash flow statement as well. 20 is the movement, and that's our check. So if we multiply the sales by the 20, we should be getting the 20. Now, this is for all the more financial gurus on the call. I can use that terminology, it's on the operating cash flow level, right? So it's not in this scenario. I'm not trying to use like looking at your loans or assets that you purchase. All of those things also impact the cash flow. But this is purely now in this scenario to understand the operational cash flows. And so now what I would like to show in scenario two is if we keep the exact same position that the company had, but let's say, for example, we're still carrying inventory of 10 at the end of the period. Let's say, for example, you replenish some stock right at the end of the period. So what effectively what you've done is you've taken your cash and you've invested that into inventory, right? So if you look at the cash flow and to make sense of that, it will be your profit that you've made in cash, and then you've now purchased additional inventory. And a simple way of looking with the marginal cash flow, so we still have 20%, and if we use the working capital as a fraction of sales method, minus 10% of that has gone into inventory. So therefore, we understand the 10% movement on our bank. And so scenario three is now a combination of the stock and the creditors. So what we're doing now essentially is we're saying our suppliers have given us credit terms, and I want to really show you what the impact of this is and how powerful this becomes. So for example, here we see, okay, we still have the 20% sales. We have the inventory that we've invested in. Our creditors now have given us extended credit terms, and now that actually alleviates our cash flow quite a bit. And if you look at the percentages now, we've generated 20% on our income and our profit and loss. But where the magic happens now is on the marginal cash flow. We've actually generated cash flow in the business by just having our creditors extend our credit terms. And so 50% of our sales directly increases our bank account, right? So this is quite powerful if you to wrap your to maybe wrap your mind around it, is that you can have a company be running at a, let's say, a loss position from a profit and loss perspective. But if you get the working capital right, and that percentage is greater than the loss that you're currently experiencing, you can actually keep the company afloat. And this is also the number one contributor for early companies not being successful. And I think you guys might have, if you've done a bit of research on success in startups and startup to medium-sized companies and companies succeeding, it all comes down to getting this right, because it's got such a significant impact on our cash generation and being sustainable in the future. So that's that. Um, could also, as a scenario, I could maybe just show you guys. So these are now each of those, like I've shown in the presentation, is a specific lever. And so what we do with clients is we engage with them on our retainers, and we look at, okay, how do we solve maybe for specific scenarios. So for example, let's say in this case the client loses or the price drops by 20%. So this is on scenario three or scenario four, which is exactly the same as scenario three. Just want to check something here. Mm, yeah, this one is not actually working. Okay, it is actually zero. Okay, so we see in this scenario, it is actually, I've got a surprise from being zero. I was like, okay, what happened right now? But the zero makes sense. So in this scenario, the company has made no profit at all. It is a net 0% net profit. Um, okay, and so the working capital is still the 38% in terms of without changing any working capital. But what we can do is, for example, this is the days. So I've used the days just in a sense of forecasting what the working capital balances would be. So, for example, in this fraction, we're saying inventory is around 12 days it takes for it to turn. So let's say we can improve that by 2 days, for example. So there we'll see immediately it jumps to 42. And so in this scenario, we are actually still making 0% profit, but our working capital is contributing to 42. So it's like, obviously, it's not ideal, but I mean, we're starting to see that the working capital can really contribute significantly to your company and its success. And why is this important? I believe obviously when you guys sell on Amazon web services and being an e-commerce company or e-commerce website based company, you really want to manage your inventory and your payables, like I said, debtor days, maybe to less extent. But if we can get these two and the right combination and at all times manage this effectively, it will all contribute to our cash generation and the success of the company in the long run. So if I just jump back to my slides, I do see Michelle has raised a question there, and I do want us to take the opportunity to maybe just spend a bit of time. Yeah, if there's any specific questions for me to just also gauge better the general um, understanding in the webinar of these concepts. So Michelle was asking if you applied these cash flow principles in your business, what might change? So I would try to explain and show with those percentages. It's all about all about improving cash flow and being in a position to understand how you can improve or change some of the working capital items that will suit your company in the long run. Whether that's you're trying to get through a difficult season or a low season in sales, how do you navigate that? All about, like I said, cash flow is always king in business. And how do we make sure that we um, prioritize that in the company? And this is also semi like a self-diagnostic test to see where things are going wrong, where can I potentially change and improve that. So yeah, I don't see any other questions at this stage, but please feel free to pop a question there on that. And then in the next part of the webinar, I would like to look at the fulfillment decision. And so what I've tried to do is to have the webinar align with majority of the participants is to look at maybe like a decision that you will be facing uh, should I would consider be facing within your company, and it will apply to a bigger audience than me just trying to like be very technical on one specific item or topic, is to look at like fulfillments. So when I've done some research on Amazon web services and selling on Amazon, I've seen that you have the decision to either self-fulfill or make use of the fulfillment by Amazon, which I think is quite a nice decision that brings it all together. You've got the profitability decision as well as the working capital elements in that decision because it touches on the amount of stock that you'll be carrying. And then also with the profitability side, if you use the fulfillment by Amazon, there's certain costs that are being brought into the conversation in terms of handling, performance, and storage, and all of that. And so I thought that would be quite an interesting conversation to have. So if I go down to the next slide, to try to jump a few, I've tried to just, for example, structure the fees that are involved in with selling on Amazon. So on the individual seller plan, that's for various companies only starting out on Amazon, and you have your subscription as an individual seller plan, so that you get charged 10 Rand per item, and then later you progress with your subscription to 400 Rand per month. That is something that could impact, but to lesser extent, but it's worthwhile noting that cost. And then the referral fee with Amazon, I believe that is fixed at 5% up until March 26. Um, but there is a range that will be applied, and I think that's very crucial to understand that because your margins, if you are quite squeezed on margins or your margins are tight in certain products, that could quite easily erode a big portion of your margin. And then fulfillment by Amazon, there's a fulfillment fee per unit. Again, that's also very relevant. For each unit that you sell, you'll be incurring that cost. And then the one that I think is most relevant and very important to maybe forecast and consider with each product is the storage, because now the fee is linked as a rand per cubic per month. So the amount of storage you take up per month. Um, so that basically links with your volumes. It links with the stock turnover, it links with all of that, and then bringing that all home into saying, okay, how does that affect my profit margins? How does that affect my cash flow? How does that, how do I optimize for selling the right products on Amazon? Um, so yeah, that is just the summary of the fees. And then in an attempt to approach a way of making it a bit easier and maybe prompting some questions, I've went with the approach of saying let's use a typical product and maybe give it some values and then compare that on some different scenarios in fulfillments. So the product, for example, yeah, would be 350 retail price. With that, there's a size which is, I think it's more about the volume. So the size is there, but um, I don't know if Amazon might also quote you on the size of the product. Then there's category referral fee, and I think that promo, like I said, that referral fee at 5% at the moment, and then normal VAT. So on a comparison table of the different fulfillment types, so you can either self-fulfill the product that you've sold, you can make use of the fulfillment by Amazon, which is, and let's say there's different categories as far as I understand with the storages. So whether it's a standard size product or it's a really bulky product, they will charge you a different rate, and that's really important when it comes to the fulfillment and the storage fees that will be charged by Amazon. So in the block that I've highlighted is where the main variances lie between the different types and also that impact the profitability on each of those methods of fulfilling. So keeping all else equal, like your sales price, so we take off the VAT, your landed cost. So I'm not looking at any of that at the moment. I believe you're all happy with that in terms of, okay, landed cost, just for maybe for some people that are not necessarily that um, familiar with that, it's all the costs that you would incur in bringing the product to the condition ready for you to sell. So all the costs that you would have incurred to bring that product to, let's say, your own storehouse, or if it's maybe what you've incurred to assemble it and then get it ready for sales, all of that labor, all of that to get the cost, landed cost. But I wanted to actually hone in and focus specifically on the grey section, which the 5% is standard. So the 5%, no matter how we sell, that will be incurred. But it's like I was just saying that with a promotion, that fee is likely to increase, and therefore this assessment should always be repeated and considered with each decision that you make. Then the fulfillment fee is the one that was per unit, and we did see that it depends on whether it's a standard item or a bulky item. There's a range, and that will obviously also impact your margins. And then the storage fee is the one that's based on the size of the packaging of the product and how much space it takes within the Amazon warehouse. So that will be charged monthly, and remember, that's a cost per unit per month. But if your stock remains within the warehouse for longer than a month, then we need to either times it by two or half, depending on how long we want to actually consider the stock being in the Amazon warehouse before it gets sold. And that's the one I actually want to delve into a bit more in depth. Plus, of comparing that with your own courier costs. So let's say you've got your own delivery and you're able to calculate that cost and then weigh up the decision between the two. So what we did see from this similar product with these different methods of fulfillment, and the quick conclusion we can take from that is self-fulfillment. Self-fulfilled makes sense if you're testing a small batch and a local delivery makes sense for you. You're not that at that scale or that volume that it really makes sense to try and outsource your fulfillment. You're just like exploring with this product. You want to retain as much as the margins as possible. You want to retain as much of the margin as you can by making use of cheaper methods of fulfilling. But then the free board, the fulfillment by Amazon standard is more for a specific product that is now actually achieving scale, and there's considerable consistent volume. So it makes sense to actually maybe consider outsourcing that to Amazon, because in this scenario, you do not maybe want to deal with all of the like queries, or if there's returns and all of those things. You would rather prefer focusing on marketing, trying to increase sales, volume, turnover, all of those things. Then it makes sense to maybe consider doing that. We can see if the price and the costing makes sense, you can actually improve margins on that. And then the last one is more for your bulky type of product. There, it really makes sense if it's a premium product, because most, and if there is, I don't know what the volumes could possibly be, but it's most likely not that bit, consistent, and it's also not that high of a volume turnaround product in general. I'm making a lot of assumptions as we go as well, but I'm just trying to like explain the principles and what we need to be aware of and what we need to look out for. So we see that if the product is not really a premium and there's not a lot of margin, but because of the sheer size of the product, it might eat you into a lot of your margin, and then it might not make sense to really utilize the Amazon fulfillment product. The storage, this is a summary of what the storage is. So it's calculated per month, per cubic meter per month. Um, it's based on the product size, and either it's standard or bulk, which time of the year it is. So on peak seasons, like we'll see, there's a higher charge for this, and it's calculated on the volume and the turnaround. So the average daily volume of stock stored, all of that gets it's been taken into consideration. This is a quick summary of what I found. So the standard, there's a certain range that they'll charge you for that storage fee, and if it's bulky, then obviously it goes up. And like I said, the volume is important, and then also be aware if it's peak seasons, then most likely that cost will also be increased. Okay, here's just an example of how that would be calculated. So, for example, if we have a product and those are dimensions, that is the volume, cubic meter volume of it, and then we would apply the rate per month per unit. Like I said, that is on the condition that we assume that the product will only be there within a month, basically. But if we expect to carry stock longer or over a longer period, we need to factor in that differential and maybe multiply by 2 or 3, depending on how long the item could potentially be at the warehouse. Um, let me see. Okay, I'm still on that one. So I don't know if there's any questions at this stage. I've seen it's been a bit quiet on the chat side. Whether it's a cash flow ones that you still wanted to raise as well, or if there's questions on maybe this decision whether you should do self-fulfillment or make use of fulfillment by Amazon. We really welcome any questions at this stage. And I've also prepared some practical tips for managing storage costs. So let's see. Okay, I see Michelle, you've dropped again. You've raised quite a few. I'll first handle that, then we can look at the practical tips. So what is the one factor that most affects your margin? So when I go back to that slide, so all else being equal, like I've explained, the landed cost um, and your selling price, that is to some extent something that I think as a business owner you would know most about how you can improve that. But in terms of making the decision between self-fulfilled and whether you should be considering fulfillment by Amazon, you could then look at the storage definitely is high on the list in terms of that, and also your own career costs and weighing up that. A big thing also, I believe, is trying to avoid any out of stock scenarios. In the long run, that could cost you actually a lot more, and that's a calculation where you would have to say, okay, does it make sense to maybe carry a bit more cost, carry the stock over a longer, more stock in the warehouse to avoid any out of stock scenarios. So measuring the contribution or the margin lost by not having stock to fulfill a sale versus the additional cost you've been carrying by having that stock in the warehouse. That's definitely a big one to consider because that cost actually increases the longer you carry it. So that's why I would say it can quickly erode margins. Um, why do you think stock days matter much in your profit model? So, like I've explained with the cash flow principles, and why I think that was very important is like we did see to some extent profitability can be improved, and it's something that I highly recommend we stay on top and calculate. But to a bigger extent, you're actually making a cash flow decision in terms of how much stock you're carrying, how much you invest in that. And so, with a scaling and a growing company, that's really something you want to manage and look at very attentively because that's where cash can be drained. So, the profit is important, but it's also the working capital around that is just as important. Like I did explain in the beginning, that you could essentially still be running a loss, but if you have a working capital cycle that makes sense, it can actually carry your company through that month or that period. Um, what would you adjust if a product takes longer to sell? So definitely on that question, it might be that you will be carrying too much inventory. So maybe consider with your forecast if it's not prudent to rather reduce the amount of stock that you're carrying or trying to use promotions to sell more of the stock, get rid of or try to turn that stock as soon as possible because if it becomes stock that might be dead end or that won't be able to be sold, then it actually becomes a loss. So we want to really, that's a fine balance between having enough stock to not be out of stock, but also not overcommitting your cash flow into inventory, for example. That's something I would say becomes really important and a risk that we want to manage there. So how would you fulfill by Amazon compared to self-fulfilling your product line? I think, Michelle, that links to this conversation that we've been having here. You would want to compare your own career costs versus the ones that will be applicable with the fulfillment by Amazon. I believe I see Lee Kendricks has also raised another question that I'll try to answer. How can I use my cash flow data to make better pricing decisions when there is so much competition out there? And can seasonal sales trends be factored into cash flow planning? I'll answer the second one first. Can seasonal sales trends be factored into cash flow planning? I would say yes. I believe with the Amazon sellers dashboard, there's quite a lot of data that you can extract from that platform in terms of seeing your trends and your historical movements. I think that is very crucial. Maybe you can leverage some of that data in your decision making. And like on the first section with the cash flow, we did see we want to really try and hit that sweet spot about how much stock we carry at any point in time. And because over investing in stock in the long run might cost you and it might place the business on a cash flow strain. So it all comes down to the cash flow and definitely using data to back our decisions. Like the data won't necessarily give you the exact answer, but at least it will point you in the right direction. So that's the approach we can take. So, okay, let's use data where we can for our decisions so we at least land in the right area of concern or where the problem is coming from, and then we delve deeper into the detail because I think that's also a lot of times that we see with clients is we know there's a problem, but we first need to actually self-diagnose and see where is the problem coming from because it could be multiple factors. That's why I'm saying we want to isolate and maybe start looking at these different levers in isolation and start seeing, okay, maybe this is the one that's actually contributing the most to the problem. And that's why I say that's really important to look at that. So how can cash flow data make better pricing decisions when there's so much competition? I don't think cash flow data per se can help you with that, but it will um, cash flow data make better pricing decisions. I think that comes like pricing for me is always linked to volume as well. So pricing could never be um, discussed in isolation from volumes. So it all depends on the type of product, I believe, because some instances, if the product, if if you maybe drop the sales price, you might sell more, or vice versa. And I think that's why it's very important to look at historical data and see maybe where there's been changes. What has the market been telling you about that change, and informing you? Okay, maybe yeah, it's also a volume thing. I think the cash flow is is a result of what's happening on the sales. So, like I said, showed in that example, like if there's no sales, then anyway we won't be having profit, and it won't make sense. So, that is more of a market positioning and a strategy conversation than I would say from the cash flow itself. But cash flow can um, it's more going to help you to decide how much stock and which products you might need to stock up on, and which ones you need to maybe consider swapping around. Or it's more about operationally making successful than it will actually inform pricing by itself, I would say. I hope that answered your question. I did see that you did say, okay, thank you. Yeah, welcome. Any other questions, if there might be any questions? Cash flow, or even the fulfillment aspects. I don't know if you guys maybe wanted to also mention any other challenges that you face, or decisions that I can maybe help you decide how to explore or how to conceptualize the problem. I see Lee has raised another question. What's the most common financial mistake as I believe is as companies can make as they scale? I think it comes down to that working capital, Lee. That's very crucial because as companies start growing, and then I think the working capital levers get out of hand. We overinvest in either, you mean seller, okay? I think the response will also cover that as a seller. So I think that the main thing is that as you start growing and the sales increase, it's quite easy for you to over-invest in inventory, or commit too much of your cash there, so place your company on a cash flow burden, especially then also if that inventory is not selling very well on the platform, or you're not getting rid of the inventory. So I think that is the main thing, is just making sure that your cash flow cycle is still healthy and that it's functioning within the means that you actually meant it to do. Because I mean, it can quickly get out of hand, especially if you're still like starting to figure out how the company works, how which product combinations work, what sells well, what doesn't sell well. I'll give it. I see Lee is still typing. Uh, I'll give it another 5 minutes or so. Then we will jump into this survey if there isn't going to be any more questions from the participants. Well, I also just wanted to, if you guys wanted to reach out to us to CFO, I'm just scrolling to that. You're welcome to scan that QR code to get in contact with our company. We're happy to have a free consultation to understand your business. And that goes beyond just for Amazon specific sellers. We cater for any startup to medium-sized company. Like I said, with that fractional CFO, we can plug into any financial function out there and assist you guys on the financial side. Okay, at least there's another question here. It's quite a bit of a. Okay, I see now what's actually happening. It's typing in each of the actual chats. So I just need to look down here at the bottom. One more question. What is a seller? As one of their products sitting in fulfillment by Amazon for 60 days before selling. What practical steps would you recommend to improve cash flow and reduce the cost? So if I just go back to these back to my slides, the practical tips in terms of managing storage costs. So the first thing is use the inventory performance dashboards that are available on Amazon. There's quite a few reports that they have on there that actually give you a inventory performance index showing you how the how the stock item is performing on the platform. The other one is keep 1 to 2 months of stock in Amazon warehouses. Don't try and keep too much stock. Like we've seen on that performance, the storage costs can actually reduce or erode a lot of your margins. Remove slow moving items. So if you do see like, okay, this item not really selling well, rather pull the trigger than try and hope that it will sell. Rather maybe bite the bullet and bring in that stock item and reduce the cost because removing it seems to be a smaller fee than trying to now keep it there in the warehouse for the long run. And then also, especially when it comes to peak seasons when that cost is also going to increase, then bundle or replace slow sellers. So anything that you can do to maybe make the offer more attractive to prospective clients here. If you can't bundle some of it together, um, just so that you can get rid of it in that sense before quarter four storage rates. So um, yeah, I think that's hopefully answers your question. So maybe you can just let me give me indication if that helped you. Then, yeah, if there's anybody else that has a question or wanted to raise that, um, please feel free. And also, just a reminder, the the, the slides as well as the Google Sheet has been added to the chat to download for your own reference or to revise the material. There was another chat coming through. What do you think works better, doing it yourself or outsourcing it? Again, it's I can't give you the answer just by that because it comes down to you doing a calculation. So we must always start with the calculation. Data is the best form of decision making, and then we can start from there, maybe adding experience or adding additional market research. But I cannot just say off the top of my head without any calculation or support of what would be best. We would need to look at the cost for self-fulfillment in your instance versus okay, that specific product, what would it cost you and what is the margins that you could earn by selling it and you making use of the free fulfillment by Amazon. So it is definitely a calculation that would then support maybe some experience that you have in with that product or volumes that you expect. It's not a one size fit all. Always do self fulfillment, always do that. I think to some extent, if you just take it from a very high level, it seems like if you're starting out and you can fulfill at quite at a decent price, it makes sense to maybe do self fulfillment at the initial phases. And when you start adding scale to that, definitely it seems like that combined with the fact that you no longer have to have the worry of having to deal with the returns and all of the other admin relating to doing the fulfillment. Would you be able to answer the question after the free consultation? So definitely, I think the free consultation is to understand if we are a fit with your company and what you're doing. Um, and typically on a we retain a basis, but we can also do a project. So if you want to like do a specific project, we can get in touch and we can set up a specific engagement where it maybe just be project based, and we can look at the specific data and the scenario with you, and try and help and make sense of it and help you make the best decision. I hope that answers your question. See, so thanks. I'm happy to hear that. I still see there's 11 participants in the webinar. If there's anybody else, please feel free to maybe add a last question on that, or then I think we'll end the webinar at 20 past, and then you guys can please fill in the survey for us, and then yeah, that will be the end of this webinar. maybe is there anyone that wants to share any of the other challenges that you might be facing in terms of making use of Amazon and maybe cash flow challenges that you have in your companies? Uh, then if anybody wants to share anything else, maybe then the fulfillment aspect specifically. Well, I don't see anybody typing in the chat, so I believe that is then all for the questions. So I will stop sharing, and then we can create these surveys for you. And if you guys could please complete this survey, we will really appreciate that. And then good luck with all the selling on Amazon, and then hopefully we'll see you in another instance of this webinar. Thank you everybody for joining today. Bye bye.